So I'll record all of the courses, and then, on the weekend, or the following Monday, I'll post them, send them out to you as announcements. So I'm just basically feeding you, the content so that you can review it. And then when we get close to the exam stuff, I'll go through the exam in class, and then on a Saturday or a Friday afternoon, depending on how you want to do it, I'll do like a 2-hour review session, and you can come in and ask me questions, and I'll work through any of the problems to help you. Okay? All right, so it's just, I think it's really worked out. I think the impact and the outcomes associated with making the class videos available to you have really allowed my students to really understand the content and have them perform really well in my class. This is the Wiley Plus stuff. I haven't tested it yet, but Wiley Plus is a good feature if you need a little bit more tutoring in the finance problems or the narrated slides. If you need additional help, the Wiley Plus homepage is really good. And I'll double check and see if that's available. If you want, I can get that activated for myself, and then you guys can use it if you want to use it. Okay. And then who knew it? Is anybody familiar with this? I don't think, somebody clicked on this and said it wasn't working, so I gotta double check the URL, see if it's still linked. But here on campus, this was a resource, and it's also like Lynda, which, at USF they have Lynda, YouTube, Khan Academy, Code Academy. It's places where you can go to learn how to program in R, Excel, Python, statistical review, or micro, macro. It's just a portal, that has areas that you can go not only for review and reinforcement, but they also have certifications. So if you want to get certified in Excel or something. So I'll double check that and make sure that's working for you, because I think that's a pretty good thing. So this is how it's going to look, although I don't like this whole setup, this guy here, or this whole tie thing. I don't know what that's, usually it's just a link or something, but I don't know why it's doing it. But what I'll have is I'll have the days, and I'll have links to the videos. So you can go up to the website, click, I couldn't make it to class because I ate really bad sushi the night before, I can review, the course and not miss out, on any of the content. Okay? Between that and your team members providing you with any notes and keeping you up to breast, you should be able to keep up with the class pretty well. Here's the calculator examples. These are historical course logs. You want to go back, because this class is so much fun, you may want to go back 2 semesters and watch the last 2 semesters. And then there's notes here on the supply-demand analysis and the financial product innovation. Basically took pictures of the notes that I wrote up on the board and just posted them here. So if you want to take a look at those. Securities Training Corporation, did I already talk about this? Anybody interested in investment management, investment banking, going to work for Schwab, Fidelity, Franklin? Did I already give you these? Did you already get these? Yeah. So it's right here too. And then this, double check that. This is the SIE exam. Did I already give you this? Did you already get this? Okay. So again, this is the first level of what is called the Series 7 exam, which is the registered representative. You can't be an advisor, you can't sell financial securities if you don't have the Series 7. And what I found out when I went to go work at Schwab, they were all like hoity-toity with me. Because when we bought our company and we went over there was a local economist doing a lot of speaking presentations for a lot of real estate groups. And they said, we hear that you're doing presentations to these real estate groups. It's like, you can't do that. It's like, oh really? They said, yeah, you can't do that. We got to look at the presentation and edit it, to make sure that it's not, doesn't have any market leading comments in it, and it meets all of our compliance. I said, great, so I gave it to them. They hacked my presentation, significantly, and then they said, well, you can't go out and present these presentations, you know, in front of people. You don't have a Series 7. And I said, I do have a Series 7. And they said, oh, well, I guess it's okay, you can go out and do the presentations. So if you're going to do marketing, you want to go work for BlackRock or Schwab or, you know, Wells Fargo or Franklin, some of these top, you know, financial institutions in the marketing departments, you got to have the Series 7. Okay? So it's just something to think about if that's the direction you want to go. And a lot of people will go in that direction, and then they'll go over to the startups and stuff like that. They'll go cut their teeth at another company to learn all the best practices, and then it's like, I'm out of here, I'm going to go do something else. Maybe I go to a real estate company or insurance, and maybe I go to a tech startup or, you know, do something different. Okay. So this is all that SIE stuff. And then here's the course logs, here's the syllabus, here's the pre-test, the statistical pre-test, pre-test notes, pre-test materials. So a lot of you have already been working on the pre-test. You're finding materials online, maybe in stats books, but there's a whole folder here of pre-test material that you can use to fast track your pre-test. Okay. And then I'll go over, probably next Monday, some of the nuances on the pre-test that aren't going to be obvious, you know, from the materials, because you've already worked through them. I'll go back and I'll plug that stuff in, because a lot of the stuff on the pre-test that you haven't seen or can't find, you wouldn't know unless I went over it with you. Okay. Then the calculator manuals, anybody who wants to cut their teeth on stock market or derivative trading games, there's a whole bunch of links in here. If you take my investments class, I'll teach you how to trade and build portfolios. What else? Here's the in-class exam. I gotta update these things. Solutions to the in-class exam, particularly the problems at the back. Extra credit problem set solutions. Boom. Midterm solutions. If you want to look at those. Student evaluation elevator pitch, Finance Club worksheet, please give me those before you leave, so you can see on our mailing list. And here's some resume templates too, that you may want to take a look at. How many people have resumes? Awesome. Make sure you have Mary Beth take a look at them. If you're looking for internships or jobs, we can totally help you out. There's a bunch of internships that were just posted on Handshake. Syllabus, pre-test materials, exam solutions. Oh, and here's the PowerPoint presentations right here. What else? Here's some review courses here. Professor Souza, I don't understand econometrics. Bam, right there. Professor Souza, I really don't understand financial statement analysis. Boom, right there. Professor Souza, I need a refresher on macroeconomics. Right in there. So I basically went out, searched, and there's a bunch of review videos in there if you want to get refreshed on micro, macro, financial, managerial accounting, whatever you need. So I was just trying to create some resource guides for you. Writing resources, do you use the Writing Center here? Everything that you write, do you send through the Writing Center? No. So all of your writing is perfect. Subject, verb, punctuation, capitalization, periods, formatting, all that stuff, it's all perfect. Must drive your professors crazy when you hand that stuff in. What I would do is work on your handwriting and work on your writing, okay, for the next 2 years. Okay? And seniors, if you're not a good writer, you better be a good writer by the time you graduate. Okay? Because it's just another obstacle. Okay? And I'll go over the memos today, but it's really critical that you focus on your writing skills and your communication skills. That coupled with solid foundation, you know, in your theory and your applications, you'll be able to compete with the Cal, Stanfords, Davises, those guys.
But what within the writing, like what should we focus on when you say improve your writing?
Like your handwriting, for one, being able to take notes and be able to give those notes to somebody that they can use and type up. That's really important. The other is writing business, active voice, present, future tense, active, persuasive, I'll be going over the memos, and we'll go back and forth with the memos. And what I'll do is I'll sit down with you. You'll take an attempt at the memo, I'll sit down with you, and I'll show you how we edit memos. And then before you know it, you'll totally pick up the style, and then you'll know exactly how to do it, okay? So the reason why I focus on the communications and the finance class is I was, asked by some senior level people in industry to train you on business writing and to train you on memo writing and to train you on how to produce these pitch books. Because what's happening is they were getting candidates that couldn't do memos, couldn't write business, and couldn't do the pitch books. And they were finding that they were spending a lot of time doing rudimentary training. Some of them, some students that weren't prepped well in the academy, when they made that transition, they were working with managing directors and executive vice presidents on business communications, and they would give them critical feedback on their writing, and they would give it to them, and they would get upset. Okay? And those people usually don't last very long because we don't have time. We'll show you how to do it, we'll coach you, we'll teach you, how to do the business communications, then you get better and better at it. But if you get upset and refuse to do it, then you're just wasting your time. So that was kind of my philosophy around this. And I'm more than happy to help you. Here's the review courses, the professional licenses, if you want to get your CFA, CPA, real estate license, your insurance license, your SIE, your Series 7, your 66, your, that stuff. I can coach you on that stuff. And then we have some economic and finance videos, from people like Ben Bernanke and Janet Yellen and Kyle Bass and some other interviews that I think are pretty amazing to listen to how these people talk. That's why Bloomberg is so important to listen to, is because they use business language and they use finance language and accounting language and marketing and technology. And when you hear these senior executives speak, the way that they communicate is so precise and to the point. That's where you want to go. You want to model those people, the way they talk, and go through the self-efficacy process of learning how to communicate at that level, that precisely, that effectively, so that you can have very productive conversations very quickly and move on. Because to get in a meeting and to talk to people and to talk down and to translate is very time-consuming, inefficient, and very costly. So that's why in business you have to learn the marketing, the accounting, the entrepreneurship, the digital media, the analytics, the finance, all that stuff, so you can talk different languages to different people at different levels of the organization and across the organization to have productive conversations that provide opportunity for yourself within the organization. Okay, movie review worksheet. Here's my presentation on Trump. I tried that maybe a couple of years ago and had a lot of people in tears once they heard the truth about it. And then, unfortunately, when he presented upon election, he's actually executed on all of us, which is kind of amazing. You look at the list, and he's done everything, from immigration to defense spending to everything. Financial product innovation, sample memos from students, some sample articles, lectures on the yield curve, which I'll do, lectures on technical securities analysis, and then this is the public financial information, PowerPoints, student presentations on the pitch books and the analysis we're going to do at the end of the semester. Okay. So that's basically the website. It's a resource. Okay. Any questions on that? No? Okay, cool. Let's talk about, well, let's do the market updates really quick, and then we'll go do the memos. 4 o'clock in the morning, your traders, managing directors, we need to get an update on the markets, what's going on. Do we care about the stock market?
Yep.
Yeah, you do, because you're going to own 70% of your portfolio is going to be in stocks. Do you care if they go up or down? Yeah. If it's 2008 or 9 and the stock market careens by 40%, you see 40% of your wealth get wiped out, do you care? Yeah, because you're gonna have to work probably another 10 years to make that money back. Okay, so we track the stock market. So where is the Dow Jones Industrial Average today?
Up by 0.14%.
Yeah, how many points? You guys
it's
can
up
be yelling.
38.
What is it?
38.5.
38 points?
Yeah, 38.
Okay, to 26.
26,835.51.
So how many points did it go up?
38.05.
Is that a lot?
No.
No, it's just noise. What if it goes up 250 or down 250?
A lot.
You know, something happens. What about if it goes up or down 500? Yeah, what if it goes down 800? Yeah, that's what it did when the yield curve inverted. It went down, crashed like 800 points. It then made its way back. So the stock market's a leading indicator. It basically looks out a year in the future. And I'll show you, some examples of how you use government bond interest rates to help predict the stock market in a recession. I'll show you that at the end of class. Can you give me 2 reasons that would cause stock prices to go up?
Apple went up today.
Yeah, and does Apple make up the majority of the S&P 500 index? Yep, so if Apple goes up, then the whole index goes up. Got it.
And then
What would cause Apple stock to go up? Give me 2
they release new
reasons.
phones tomorrow.
What?
They're releasing new phones
Great,
tomorrow.
what's that gonna do to sales?
Through the roof,
And what's that gonna do to revenue?
through the roof,
What's that gonna do to earnings?
through the roof,
What's that gonna do to the stock price?
through the roof.
Got it. Okay. Excellent.
Same
And then the
with
other
power.
is lower interest rates. Okay, but yeah, that's really good.
See,
What
technically you would have bought Apple last Thursday, right, and then sell it on Thursday.
Or you would have bought Apple, 10 years ago.
Well, that too, but
And held it forever, right? I think I bought it at 50 years. It's the biggest holding in my portfolio because I bought it so long ago. It's crazy. Where are oil prices today? What are oil prices? Do we care about oil prices? Everything you have is petroleum based, so it's all based on oil. So oil is the biggest input into not only consumption but also in production. So it has- what is it?
Pasta.
No, I need to know the price.
58.33.
Got it. Is it up or down?
Up.
Okay, give me 2 reasons that would cause oil prices to go up.
Didn't they wasn't it today, like the Saudi, they just put like a new person in charge of oil today for Saudi?
Yeah, and what did they also say they were gonna do? You guys could be Googling this, right? You're the most powerful generation in the world to have instant access to information instantaneously. Okay, give me a demand factor that would cause prices to go up. What would cause oil prices to go up or demand to go up?
Higher demand in gas.
Can you give me a measure of demand? Demand's kind of a big term. Can you be specific?
Well, we had a lot.
Consumption, production, think about your economics classes.
Well, you would have had an increased demand because you have a holiday last weekend.
Yeah, but give me a measure. Give me economic indicators. What's a measure of demand? Consumption.
Consumption, yeah.
Demand, consumption. Demand, production. What's the number 1 coincident indicator that measures production, economic production?
Natural disaster.
No. An economic indicator that's a coincident indicator that measures the overall economic activity and production. Got it. Gross domestic product. Got it. So if oil demand goes up because of higher global gross domestic product, is that going to cause demand to go up or down? Up. If demand goes up, what happens to prices? Goes up. Got it. Okay. Give me another reason that would cause prices to go up, not on the demand side, but on the supply side. Would be low supply or oil production cutbacks by the OPEC cartel, if you read the news. Okay. So basically the OPEC cartel basically said they're going to start cutting back on production to try to prop up the oil prices. Okay. So you got to read the news. What about gold prices? Can you give me 2 factors that would cause gold prices to go up or down? What did gold do per ounce today?
Is it down?
Was it down? Is it down?
I have it as down on mine at least. I don't
Okay,
know if I have the
2-1.
right one or not.
2-1.
14.96.
Is that correct?
I don't know.
No, it says
That's
it's
why I'm worried I got the
negative
wrong one.
What is it?
negative 12.90.
Okay, what's the trading at per ounce? What's it trading? You gotta look it up. You gotta be engaged, you gotta find the information. Go to Yahoo Finance.
Oh yeah, gold's trading at 1,500.
Okay,
So I had a little
1,500.
bit.
Is
I
it
had a
up or
different
down?
one. It's down
Okay.
$8.05.
Okay, can you give me two factors that would cause
Well,
gold
this-
prices to go down?
Dow Jones is up. So
Yeah,
gold
you're
is
selling
up.
off gold and you're going
You buy Dow.
into stocks because Apple's going
Because
up.
Apple's about to go tomorrow.
Exactly, okay, that would be one, give me another. Is gold a store of wealth?
Yeah, but it also rolls around with those like 4 different options for gold.
And is gold a commodity? Do central banks and treasuries on a global basis hold gold? Do people buy gold if they think their currencies are going to be devalued?
Yeah.
Yep.
Yes.
Okay. So currency devaluation is the number one factor that causes currency to devalue. Inflation is the number one factor that causes currencies to devalue. Inflation is the number one factor that causes currencies to devalue or depreciate. Inflation.
Yeah.
Yes, got it. So if you think your currency is going to deflate or depreciate, are you going to buy gold? Yes. If you think it's going to appreciate, are you going to buy or sell gold?
Or the euro's down, that's why too.
What?
The euro's down even more.
Yeah, so probably due
That would
to deflationary pressures.
Down to 1.1.
So you would
1.10.
geopolitical risk and inflation. Okay, gold prices are highly correlated to inflation. Okay, if inflation goes up, people buy gold. If it looks like deflation or disinflation, people sell gold. If there's political instability in the world, people will buy gold as a safe haven. If they see less political instability in the world and less geopolitical risk, they're going to sell gold. So the Middle East, the Russians, Syrians, Argentina, Venezuela, all of those global factors have a major impact on gold prices. Where is the 10-year Treasury yielding today? What is the interest rate on the 10-year Treasury? Do you have a question? Okay. What? Oh, cool. Nice. Thank you for doing that. Where is the 10-year Treasury yielding today?
162.
1.62. Is it up or down? It's up. Did I go over the Fisher equation with you? No? Okay. Nominal interest rates. There is what is called the Fisher equation. It determines nominal interest rates. Irving Fisher is brilliant. He lived decades ago. He developed very simple mathematical equations to basically articulate the economy and also interest rates. And this is my nomenclature. Your book might be different. So nominal interest rates, okay? Interest rates on, let's say, 10-year treasuries. Okay? The federal government and corporations issue bonds, okay, which are securities. These bonds pay an interest rate, a coupon interest rate, and pay you back your principal at the end of the maturity. U.S. government bonds are considered risk-free. Corporate bonds are considered risky. Okay, so the yields on corporate bonds are higher than government bonds. And corporations and governments will issue bonds with different maturities. 3 months, 6 months, they all come due. 9 months, 1 year, 3 year, 5 year, 7 year, 10 year, 20 year, 30-year bonds. Okay? And the 10-year Treasury yield is the most important because it's the benchmark interest rate in which your car loans, your student loans, personal loans, and mortgages are priced on. So if I'm going to go buy a home, I think I got my mortgage rate for 3.88, mortgage interest on the 30-year fixed. And the 10-year Treasury is what, 1.6? So that difference between the 3.88 and the 1.6 is the default risk premiums, the illiquidity that bank needs to tack on to that interest rate to make sure that they get paid and they make a profit. Okay. So the 10-year U.S. Treasury yield is the most important. And the theory is that the 10-year Treasury yield is made up of a real rate harvest caused some type of inflation expectations. So if I'm a bond investor, this is the biggest thing I'm worried about. So I want to buy a US government 10-year treasury bond or a IBM 10-year corporate bond. My biggest concern is that the yields on these bonds, the coupon payment that's paid, and the principal that I get back at the end is fixed. Okay? It doesn't grow over time, right? It gives me some appreciation. It's fixed. So my problem is that I'm going to buy let's say I buy a 3%, annual yielding bond for 10 years, but the inflation rate is 3% per year. So the money that I'm getting at 3% from the bond is being eroded and eaten away by inflation. So I'm actually getting 0. Okay? And if inflation is actually higher than the interest rate paid on the bonds, I'm actually getting a negative return, which is the biggest issue right now.
I was gonna say, is that the issue, like, I saw a thing on the news the other day about like Switzerland and,
Yeah, they're
How they have,
issuing
like-
negative yielding bonds,
Bonds.
which basically means that you are paying them
to hold your money.
to buy their bond. That's right, so they're basically taxing you. So I will give you my money, you will provide me with liquidity, but I'm gonna get a negative interest rate, and I'm gonna be worse off in the end. That's why negative interest rates are horrible. And actually, some countries are trying to reverse it, because it's basically, it's actually causing the capitalistic system of circular flows to basically disintermediate and collapse on itself. So actually, capitalism does not work in a negative interest rate environment. It actually hurts the banking system, which is basically the grease and the cog that keeps the economy lubricated and growing. Okay. So the real rate and inflation expectations. Okay. So I want to be compensated for the deterioration in my purchasing power. Okay. So I add this on to the real rate to get the yield on the 10-year treasury.
Is there an asterisk on top of it?
Yeah, I just E star. That's my nomenclature for inflation
Exponent.
expectations.
Oh,
It's what I use.
okay.
So movements in interest rates can come from real rates, but real rates are pretty stagnant. They don't move on a daily basis. They either move cyclically or secularly. They don't move, on a daily basis. So the majority of the movement in 10-year treasury yields comes from where? Changes in, say, inflation expectations. When you hear the Bloomberg people talking, they might be talking about inflation using the consumer price index, which is actual inflation. But when you're talking about bond yields and movements in bond prices, they talk about inflation expectations. Okay? So it's just a nuance. So if inflation expectations go up, what happens to the 10-year treasury yield? If this goes up, then this goes. If this goes up, this goes. If this goes up, this goes. If this goes up, this goes. I drive my students crazy this way until I get the right answer. If this goes up, this goes. If this goes up, this goes.
Ah.
Got it. Perfect. So I'll keep you asking you the questions until I get the right answer. It drives you crazy, which is my goal. All right. So if inflation expectations go down, what happens to 10-year treasury yields?
So that,
So what did the 10-year treasury yield do today? Did it go up or down? Went up due to higher inflation expectations. Exactly. And inflation expectations are also highly correlated to economic growth. So if they're seeing Apple blow it out of the park with its new phone sales, that means there's discretionary income in the economy, personal income growth. People are going to buy their phones. They're not buying phones in a recession. They buy their phones in growth and peak phases of the business cycle. So that would be an indicator of economic growth, higher inflation expectations, and higher 10-year treasury yields. And people are selling off the bonds, driving bond prices down, driving up interest rates, and buying the stock market, because they see higher economic growth. In the future, they don't want to be in bonds, they want to be in stocks. Okay, all right. Okay, where is the dollar to the pound?
1.10.
What is it?
1.1.
1.1? Are you serious? Wasn't it trading at 1.2?
On Wednesday, it's
So
lost
basically, it cost me
$10.
$1.10 to buy a pound. Did the dollar appreciate or depreciate?
Appreciated.
Test question.
Appreciated.
I could buy a pound for $1.20 a week or two ago. Now I can buy it for $1.10. Did the dollar appreciate or depreciate?
Appreciate.
Appreciated. Did the pound appreciate or depreciate?
Appreciate.
The what?
Depreciate.
It depreciated. Okay, why did the pound depreciate?
Brexit.
Brexit and
Brexit.
yeah,
Oh,
Boris
wow.
Johnson's actually, dissolving Parliament for the first time in history, or it's only happened like 2 other times.
So
He's
is this
dissolving them to basically, and he's not going to negotiate Brexit with the Germans. And he's saying we're going to do a hard Brexit, and if you're not with me, you're out. Winston Churchill's grandson, out. My brother, out. You're out. You're either with me or you're not with me. So the England parliamentary system and democratic system is an existential crisis, which is being reflected in the devaluation of the pound.
So if you're a currency trader though, would you be in a holding pattern right now, or would you be purchasing,
Now you would be shorting.
shorting?
Yeah, you would go short the pound,
Making-
long the dollar. Short the pound, long the dollar. And then they're actually forecasting the pound to go to parity with the dollar, which has never happened before in history.
So when it hits parity though, if you wanted to get into it, would that be when you would buy?
You'd have
pounds?
to do fundamental economic analysis and technical analysis in conjunction to determine if it had hit a floor and it would be a buying opportunity. You would have to see some kind of reconciliation resolve in the political crisis that's currently occurring in the UK. So maybe Boris is out, they form a new government, Jeremy Corbyn comes in, I don't know what it's gonna play out, but it's kind of a joke, okay? What's going on? It's winner take all, prisoner's dilemma, game theory played out at its worst. And unfortunately, it's gonna be the UK people that'll be hurt economically, but they may get their sovereignty back. So is that worth it? Get your sovereignty back, but your standards of living fall by 20, 30%. I don't know, but it's not a question for me. It's more political science. All right, so let's do the memos. Okay? Let's do memos. So watch the markets. Let's do these memos. Do you have examples of the memos? Do you have examples of the memos? Okay, cool. So what I did was for my last class, and I kind of confused them, so I'll try not to confuse you. But what I did is I put up like a template of the memo. I'll walk you through the memo criteria, so you know exactly what the standards are that you're going to need to adhere to for the memos. Does anybody need any extra memos? Everybody got an example? What's the first memo we're going to do? Stocks. What's the second? Oil. What's the third? Gold. What's the fourth? Bonds. What's the fifth? We're going to need the US dollar. I'm going to erase some of this stuff to clean it up. And then I'll go over it with you. And you want to use this language in here exactly. Okay? This is how the sentence structures are set up. So where do you think the stock market's going to go? We're gonna go up or down, it can only go in two directions, right? Right, up or down, so that makes things a little easy. I mean, it can go sideways, but it usually goes up and down, so there's only two directions in which these prices can go either up or down. So where do you think stocks are gonna go? Are interest rates high or low? Are interest rates high or low? Low. Okay, is that good? Companies can borrow cheaply, I can borrow cheaply, they can invest more, and we can consume more. Is that good for the economy?
Yes.
Is that good for stocks?
Yes.
What was the earnings picture for Apple? What was the earnings picture for Apple today? Was the news for Apple positive or negative?
Positive.
Positive. Does Apple make up the majority of the market capitalization of the S&P 500?
Yes.
Yes. So if people think that Apple is gonna do well because they're selling more phones, which is a positive thing, which reflects growth in the economy and not a recession, would that be positive for stocks? Yeah, absolutely. Okay. Gross domestic product came out the other day at 2%. Is that positive growth?
Yeah.
Yep. It's not 3%, but it's 2%, but it's not 1% negative growth. So the economy continues to grow. Is that good for stocks? Yeah, absolutely. And inflation is relatively low too. I think it's around 2%. Is that good for stocks?
Yes.
Yeah. What about the unemployment rate? Where's the unemployment rate today? These days? If you go up to the Bureau of Labor Statistics, www.bls.gov. Go ahead. You can do it. That's why we have computers in this house. Where is the unemployment rate today?
Unchanged at 3.7%.
3.7%. Is that higher or low? That's low. Is that like a 40-year low? Although us economists like me believe that the unemployment rate is artificially low, but it's still low and people think it's low. And that's positive for stocks. Okay. So where do you think the stock market's going to go? So we'll just say it's going to go. Okay. So stock price, okay, so let's do this. So this is your memo. First thing is the memo. Okay. It's got to be in capitalization. Okay. It's got to be bolded, in caps. And I think 18 point, does everybody know font size, points? 18-point font size, do you know that?
Yeah.
18 point, we'll try with that and see how it looks. All of this is going to be in, except for that, everything is going to be in 12-point New Times Roman. Not Times Roman, but New Times Roman, okay, because that's business. All right? Then you're going to have date, capital D, date with a colon. And then you're going to indent. Okay? Monday, September 9th, 2019. Then you're going to have 2, colon, indent, to me. From, colon, indent, from you. So these are all flush. Okay? These are flush. And then the RE, right here, needs to be capital R, capital E with a colon. Okay? And then this line right here, you don't want to have too much space between these two, and you don't want too much space between here. I've seen some memos where there's like 2, 3 spaces, don't need that. They should be equal, but just enough space, but not too little and not too much. Okay? Because you need white space when you read, because your eyes rest. Okay? And it allows you to move through the memo or the report. We're forecasting what? What are we forecasting?
Stock market.
Stock prices. Yeah. So stock prices forecast to rise 5% over the next 3 months. So this is how I do it. Upper lowercase. Okay, uppercase, uppercase, okay, upper lowercase. I don't do uppercase, lowercase with the 2 or the. Okay.
Propositions.
Huh?
Or prepositions. Prepositions.
prepositions?
Yeah, like to, the,
Yeah, I don't do that.
okay.
I don't capitalize those, okay? And then what I do, which is wrong, but I like it, is I use a 3. You're supposed to spell it out, but I like numbers. So quickly I can read, what your forecast is, how much it's gonna go up over what period of time. Okay, and in the last class, they asked me, he said, Professor Souza, what's the range, in which, these prices can move, okay? And right over there, stock prices can easily move up and down 10% over a 3-month period, because stocks are so volatile. Oil, gold, and bond prices, I would say the range is about plus and minus 5%. And then foreign currency, the US dollar, I would say 3%. Okay, so you have kind of a guide for what the percentage changes are going to be. So you just have to decide what's the direction, up or down. Okay. And as you read more about these asset classes, you're going to have an opinion and start to forecast. Okay. And that's a big breakthrough for students, is to be able to feel comfortable forecasting. As professionals, that's how we're paid. You're going to move on into your career with experience and knowledge, and people are going to ask you what you think. What should we do? What do you think is going to happen? Okay. They're not going to ask you what happened today, maybe, or what happened yesterday, maybe, but they're going to be more interested in what you think is going to happen in the future, and what are we supposed to do? What do we do? Okay. So you have to change your mindset from past tense to present and future tense. Active, persuasive writing to convince people to do this. Okay. We are tracking stock prices, period. Again, you got to use this language exactly. And then what you do is you swap out stocks for oil and gold and bonds, and then finally currency at the end.
Is the top part a double space?
Which one? Here?
Yeah.
Yeah, these are double spaced. I'll use this as a double space. Yeah, because it doesn't look right when it's single spaced. It's too cramped. Good question, thank you. So, this is the language, it's very precise. We are tracking stock prices based on our research. Not I, not me, we. Based on our research, we forecast stock prices to rise 5% over the next 3 months based on the following factors. So, going to be higher or lower earnings expectations? Higher or lower? Higher. Got it. Is it going to be rising, high and rising interest rates, or low and falling interest rates? Low and falling. And rising or falling global gross domestic product? Rising. Got it. Therefore, we recommend the following 36 trades. So based off of your forecast, based on the factors that you've used to forecast that stock prices are going to go up, you are going to recommend 36 trades to your clients, to the proprietary trading units. You're going to trade these yourself.
How did you get the rise of 5%?
Well, I could have used 10% if I wanted to, or I
You
could have
just
used
have-
8%.
Okay, that's what I was wondering. We just
You
have,
know it's going to be up.
we just have to make it up when we do it? Or?
Well, I used a 10% limit.
Oh, okay.
And if the percentage change is too low, I can't do these trades. So I was thinking, okay, 8%. Could stock prices go up 8% over the next 3 months? Oh, totally. Could they go up 10? Yeah. Could they go up 20? No, too much. Okay. So based on history and just based on deductive reasoning, you kind of know what the range is. So I just kind of set the range. You tell me, is it 5%, which is kind of low but positive, Or is it, the market's really gonna go up pretty significantly over the next 3 months? So I'm gonna put in 10. It's up to you based on your research to get comfortable with it. Okay, now we have the trades, okay? And these trades, what we're gonna learn is how to trade derivative contracts, okay, derivative contracts. These are financial instruments to be able to trade off of the indexes and the exchange traded funds and trades. I'm going to show you the trades. If you want to learn about this stuff, I'll go over it with you. But usually we get to derivative trading, options, and futures, contracts in chapter 20. So basically not until like the last quarter, of the class. By that time, you're burned out, checked out, and you're not going to learn this stuff, okay? So I bring it forward up to the front of the class, and you go over and over again until it just is in your brain, okay? So you're going to learn this stuff right up front, and then we'll go over it through the semester so you remember, okay? All right, so we're tracking and trading 3 stock market indexes. Can anybody give me the 3? Give me, what?
The Dow Jones.
Dow Jones
S&P,
Industrial Average,
S&P 500,
Standard & Poor's 500,
NASDAQ.
and the NASDAQ Exchange, National Association of Security Dealer Quotes. The NASDAQ is where most of the tech companies trade. The Standard & Poor's 500 are the top 500 companies by quality, financials, sales, asset quality. They're the top 500 companies that trade on the New York Stock Exchange. Okay? And then the Dow Jones is an industrial average of 30 stocks, which isn't a big sample, but it's the oldest stock market index that dates back like 167 years. Okay? So we're tracking and trading 3 stock market indexes. Okay? We're also tracking and trading 3 exchange traded funds, okay, which are also called ETFs. ETFs were invented by BlackRock. Anybody hear of BlackRock? BlackRock. The biggest money manager in the world. I think they manage like $3 or $4 trillion in assets, which is unfreaking believable. And they financially engineered and invented the exchange traded fund to basically take market share from mutual funds. You're reading the chapter, all this stuff is in the chapters. Okay, but we're trading 3 exchange traded funds. And we're trading 5 stocks. Okay. So for the indexes, we are going to, and you want to write this down and use these exactly in your memos. Don't make stuff up. Okay. There's only 2 sets of trades. When prices go up, when prices go down, that's it. So that's all you got to do is memorize the trades. We're up and a down. That's it. So we're going to buy forward contracts, forwards, and I'll go through these next class. We're going to buy futures, contracts. Could you also just go do the research on these things? You probably could just Google these things and figure these things out like in 10 minutes.
That's the on my piece of paper.
Huh?
Right here on here.
Yeah, it's on there too. But I'm saying if you want to know what these are, you could probably go look them up. I'll do a lecture on them. You could do some research on them. You could buy what are called call options, calls on the futures. And you can also write puts on futures. So basically I have 3 indexes that we're tracking and trading, and I have 4 trades. So how many trades do I have? Just on the indexes.
12 long.
Yeah, I had 12. So I had 12 ways of making money, if you're right. And the beauty of these derivative contracts is, let's say I work for a company, an investment company, a trading company, they can give me $10 million, and I could, instead of just buying the assets, outright in the market, I can use derivative contracts and leverage that up to $100 million, and potentially make hundreds of million on my trades, if I'm correct in my forecasts, as opposed to just investing 10 million. I can invest in these derivatives and place $100 million worth of trades. So that the power of leverage from these contracts is huge. And all corporations use these derivative contracts. Apple, Salesforce, IBM, Tesla, you know, they're all using this stuff in their finance and treasury departments. Okay, so they're standards. I can also invest in exchange traded funds, which are shares that trade on the exchange, but the exchange traded funds are portfolios. Okay, so it's a mix of securities, it's a portfolio, but the portfolio trade is as a share on the exchange. Okay, and BlackRock invented these. So we have 3 exchange traded funds. We think that the stock prices, you want to write this down. I'm going to write this down. You're going to buy on margin. So that's your trade. Okay. I'm going to buy on margin. I got $100,000. I want to buy this exchange traded fund. But I really want to buy $200,000 on it. But I only got $100,000. Why don't I go to the brokerage firm and say, hey, will you lend me $100,000 at 9%? Yes. Now I got $200,000 to invest instead of $100,000. So if I'm right, my return on equity goes through the roof because I'm using leverage. Okay. I can also buy calls, or what are called call options. And I can also write puts or put options. So I got 3 trades and 3 exchange traded funds. So how many trades do I have on the ETFs? 9. I got 9 trades right there. Okay. And then the trades for the exchange traded funds are exactly the same for the stocks. Okay. So if I get one right, I got the other one right. I'm going to buy a margin. I'm going to buy calls. And I'm going to write puts. Got it. So I got 5 stocks and 3 trades. How many total trades do I have on the stocks? 15. 15 plus 9 plus 12 is 36. So I got 36 ways to make money based on your forecast backed by the economic and the financial logic. Okay. That's why finance is so powerful, because it's a technology. Basically, the securities are technology that allows you to hedge risk, but also take advantage of markets if you're correct in your forecast. Okay. And that's why you're here studying this stuff. Okay, awesome. So then underneath here, you have the tickers. Okay, underneath there on your memo, it says tickers and trades. So there's no ticker symbols for the indexes, so I just put in the Dow, S&P 500, and the NASDAQ in abbreviations. But the exchange traded funds, the shares that are traded on the exchange, they do have a ticker symbol. Okay. So what I did was I said, okay, I want to find a Dow Jones exchange traded fund. Google it. Dow Jones Industrial Average Exchange Traded Fund. Boom. Fidelity, Franklin, Vanguard, Schwab, all of these companies come up. Pick a ticker, put it down there. Then I said, okay, I got another, why don't I do S&P 500 Exchange Traded Fund? All right. Pick a ticker, put it there. Why don't I find a NASDAQ, National Association of Security Dealer Quotes, Exchange Traded Fund. Google, pick a ticker, put it there. So part of the exercise of the memos is doing the research and seeing where the research is. Then what I usually do is I will go and I will look at a fact sheet. So on the websites, over in the right, there's a PDF that says fact sheet. Click on it. And what it does is it lists the top holdings of the exchange traded fund, what the majority of the holdings are within the fund. And then what I do is I pick the top 5 companies, look up their ticker symbols, and I put them over here. So obviously Google and Amazon and Apple, are going to be, make up the majority of those indexes. Okay. So I put their tickers right there. And these are all right justified within the cells. So that's totally awesome. Then what I do over here on the bottom part of the memo is now I put in the data and the analysis to support my forecasts. Because again, this is a persuasive memo, right, of business. So I got my bullet, and then I have my data in here. Bullet, paragraph, bullet, maybe 2 sentences in each one, no more than 3, okay? Not 1, 2, no more than 3 sentences, okay? So I got my bullet points right here, okay? And this is how it should, this is an example, okay? Since January, the S&P 500 rose from, give you the index level as of January, to Y, whatever it is today, comma, up some percent. You're gonna have to calculate the percentage change. Now you're in analyst. What did the index do over a period of time, and was it up or down by how much? So if you're saying that it went up, well, that's gonna totally support your forecast. You can talk about earnings, you can talk about interest rates in your global GDP if you want to. You can put the data and the analysis in here, and when you do put the data and show the percentage changes in here, you want to bold the percentages and you want to bold the data. Because I'm going to be scanning these things and I'm going to be memorizing the data. These are technical trading briefs, okay, that you would be giving me, the managing director, to basically screen at 3:30 in the morning before a 4 o'clock meeting. Go into the meeting and say, I've reviewed all of your trading briefs. Here are the ones I'm going to fund today. Here are the ones that need more research, and here are the ones that have been rejected. Okay? And then we do it again. So it's very precise communication techniques. Because the data supports your forecast, and you give me the factors, and you give me the trades that tell me how we're going to make money on it. Then over here, you're going to get a chart, a graph. It's got to go back at least 3 years, because I got to be able to see the trends. And I would go to stockcharts.com or bigcharts.com are the 2 sources that I think are the best to pull the charts in, because they're uniform, they look really good, and you're not getting charts from 2 different sources, you're getting them from 1 source at the same period of time. Okay, so they're really good.
Bar charts and all that.
Stock charts and bigcharts.com are the 2 sources that I use. And then what I do to help me with my desktop publishing, because it's really hard to just copy, paste a graph in there, and then it messes up all my formats. What I do is I do a text box. I put the graphs in the text box, and then I rearrange the text box so it's sitting within the space within the page, and then I get rid of the black borders. I turn them white so that the graphs are nice and clean, sitting on the desktop on the page. And I got a little space right here between the 2. So the width of the graphs are the same, the height of the graphs are the same. They look like sister, brother, they look the same, nice and clean. They're rectangular, they're not square, they're not huge, they're not in the margins. They look beautiful. I think most of the examples that I gave you look really nice. Yeah. I mean, these are really nice memos. And then I do the same thing with the bullets here in the text boxes. I'll do a text box, I'll put the bullets in, a single line spacing. All of this is single line spacing, not 1.5 line spacing, not 2 line spacing. Your margins are 1-inch margins around. Okay, and then we'll play with them and orient them a little bit more. I always like to have a little bit more white space at the bottom of my memo so I can write notes. Okay. And then the last piece here is I take the introductory paragraph, the thesis statement, and I copy it and I paste it down here as the conclusion. And the only thing I do then is I change following right here to above, and I change the colon to a period. Makes it very efficient. So the reader, when they read it, you suck them in with this, you build your case, you seduce them, with the trades to make money, you prove your case, and then you hit them again at the end, and you got them. You got them hooked. Okay. So it's a pretty powerful instrument. And then I just used this as a template the other day for a bi-weekly update that I'm doing right now for a client. So I use this, it's in a memo format. I basically replicated this, send it to them every 2 weeks, with the memo, and then I have an appendix, and they love it. They think it's great. Okay, so that's the memo. Any questions? How are we doing on time? How much? Okay, I'm going to let you guys out a little early. So the last thing I want to do is kind of jump to the chase a little bit here. What we'll do on Wednesday when you come in, if you're presenting, go up and load up your PowerPoint presentations. And then if you're not presenting, grab some highlighters, these things, and go hit the board and put your problems up. And then what we'll do is once those are set up, the people who are doing the PowerPoint presentations will do the presentations, and then we'll go around and everybody will present their problem. It's really fun, actually, than just sitting there and listening to me jibber jabber jawbone for an hour and a half. Okay. So the thing I want you to do is I want you to type in to a URL, dynamic yield curve. Okay, and I think right down here it says dynamic yield curve charts support. So click on that. That's not where we're going. Okay. And this talks about yield curves. Okay. And I'm like a big yield curve person. I've been studying it for years now. I was told I spend too much time on yield curves in my class, but you can't study finance without understanding what the yield curve is, okay, and the dynamics. So what you want to do is click on dynamic yield curve. Right here, this tool, right there, the tool, and boom, and I'll explain why we're doing this, okay? Why this is important. Okay. So these are maturities for government securities, okay? U.S. government treasury securities. The government issues treasury securities to finance the budget deficits, okay? If you don't have enough tax revenues, you got to issue bonds to fill the gap, okay? And the U.S. Government treasury securities market is the biggest and the most liquid in the world, and the US dollar is used as the reserve currency for almost all international transactions. That was the deal we cut after World War II, okay? That we would be the world police person for democratic capitalism. We would pay for it in exchange for our currency to be the reserve currency in all international transactions transacted in US dollars, which has been a great deal for like 80 years, although Trump wants to try to destroy it. But that's beside the point. That's a political science question we're getting into. But here's the yield curve. These are the maturities: 3-month, 2-year, 5-year, 7, 10, 20, and 30-year bonds. Okay. And then this is the interest rate on these bonds by maturity. So this curve right now is as of today. Okay, this is as of today. And the yield curve should be upward sloping and normal, but it's inverted. Okay, the yield curve is inverted for the first time in 10 years. Okay, when the yield curve inverts, the stock market peaks in less than 12 months, and we're in a recession in less than 24. It's been an extremely accurate predictor stock market peaks and recessions since 1974. And you can even go back to 1947. And you can even go back to the late 1800s. And it's very powerful predictor. That's why people are talking about it. That's why it's important. Okay? And I've been talking about it for a long time, and it's finally inverted. Okay? But let me show you. If you go down here and you click on animate, this yield curve is going to start to change. It's going to start here. This is the S&P 500. Okay? This is the stock market index. Okay? And what you're going to find is that the curve is going to be very steep and upward sloping as you start to approach the peak. Then as you approach the peak, the curve is going to flatten, and right before the peak, it's going to invert, and we go into a recession and a stock market correction. Every single time. Okay? So let's take a look at it. So as you can see in 2000, the economy was booming. It was the stock, it was the, what was it, the dot-com boom. The interest rates were really high because the economy was booming and the Fed was freaking out. So it started to sell bonds, flatten the curve, and watch. All of a sudden, the yield curve inverts. So it basically means the Fed is selling bonds, driving down bond prices, driving up interest rates. Now we go into a stock market correction and a recession. The Fed starts to buy short-term bonds, driving up bond prices and driving down interest rates to try to stimulate the economy. Because if interest rates are falling, I'm going to borrow more and consume more. Businesses are going to borrow more and invest more. So the Federal Reserve is buying, driving up bond prices, driving down interest rates to stimulate the economy and put a floor under the stock market correction. Because this is your 401k going down, right? So they're trying to use monetary policy to put a floor under the stock market correction. So this is a normal curve, okay? Positive inflation expectations. Usually we never fall into a recession when there's a normal curve. But as you can see, as we start to approach the peak, not only is the stock market bubbling up, but the economy is overheating. So the Fed is selling off the bonds, driving down bond prices, driving up interest rates, and watch what happened. Oh, did it invert? It looked like it did. So that was like an early signal. And then as we get closer to the peak, it just inverted. Okay. So then it inverts a year before the stock market peak. That's about 12 months. And then boom, we go into, in this case, this was the financial crisis. Okay. So the Fed, all of a sudden, as we start to go off a cliff right there, they start printing a ton of money, buying bonds, driving up bond prices, and driving interest rates down and normalizing the curve. This is what Trump's been saying. The curve is inverted. Lower interest rates. Bring the curve down. Make it normal again. Stimulate the economy. It would go up like a rocket ship right before the election so I can get reelected. Okay? So that's what he's looking for. But here, this is the first time that interest rates went to zero. Okay? We've never had zero interest rate policy before. In Europe and in Japan, they went negative. Okay? So it's a whole different type of financial business management model that you guys are operating in. You got to be smarter. You got to really study and understand this stuff because you're going to be managing in a riskier environment. So you got to, and this is what we talk about at the table in the board meetings at the senior level, executive level. We're talking about yield curves and yield curve inversions. And when's it going to happen? And if it does, is it going to be the precursor to a stock market peak and a recession? If it is going to be a precursor to a stock market peak, then we should probably issue our stocks down at the peak of the market. Because when the market goes down, we don't want to be issuing our stocks, when the stock prices are really low. So as you can see, the Federal Reserve just pegged interest rates at zero. Printing, buying, driving up bond prices, keeping interest rates at zero. And then what they did was they went further out on the curve and started buying longer maturity bonds, flattening the curve even more to stimulate the economy and to keep it going. Well, what they did in the process is they created a stock market bubble because they printed too much money and kept interest rates too long, which is what they've done before in the past. And you can see that the interest rates, the short-term interest rates have now gone from 0 and are now starting to move up. And the yield curve is starting to flatten. And yields are starting to go up higher than long-term interest rates because inflation expectations in the short run are higher, but as the inflation expectations for the future are going down, people are anticipating a recession. And this is how the curve looks now.
So it's good for a correction.
So it's like normal here, but it's inverted here. And Trump wants the Fed to lower interest rates, to normalize the curve, to bring down short-term interest rates to stimulate the economy, to increase consumption and investment, to basically mitigate the probability of a recession during an election year, where they end up losing both the House, the Senate, and potentially the presidency. But the Fed's not doing it. The Fed's not lowering interest rates fast enough because they don't want to be perceived as being controlled by the administration or Congress. They want to maintain their credibility and their independence. And that's a whole philosophical debate around independent central banking and the credibility of the Fed. But the Fed is the #1 institution. It brings the punch bowl to the party, and they take the punch bowl away from the party. So everybody's focused on what the Fed is doing. If you know that they're going to take away the punch bowl, then you probably want to start selling your stocks and buying bonds. If they're going to bring the punch bowl to the party, then you probably want to buy stocks and selling your bonds. So we're all listening to what Jerome Powell says. We're listening to, reading the minutes behind the